Yeah, would like to welcome you to our lesson number 7 on tax compliance and emerging issues in tax. I'm your presenter, Spear John Machere. We begin by introduction. What do you understand by the tax compliance? You're saying that tax compliance refers to the taxpayer decision to comply with tax laws and regulation by paying tax timely and accurately. High rate of tax compliance could maintain healthy public finance without imposing tax burden. That's basically the meaning of tax compliance. Saying that the taxpayer is able to comply with the tax laws and regulation in a simple term. Good. Why should you be tax compliant? Yeah, importance of being tax compliant to a business and to you as an individual. One is to access capital. A tax compliance certificate is necessary when applying for loans in financial institutions. Absence of it can deter a company from accessing capital to boost its operation, which can affect business productivity. Of course, banks and other financial institutions cannot dare to give loans to a company that may close down due to tax compliance issues. Yeah, an example is the recently Keroche Breweries company had an issue with tax. Yeah, lucky enough that it was sorted amicably. But in other scenarios, the companies would close down. And when they close down with finances or loans from a bank, that is it will give other procedures of recovering the loan that was given to them. So access to capital is a very important element when it comes to tax compliance. 2, improving business operation. Business with solid compliance programs in place perform better than the equivalent. One assumes that a business that spends less time dealing with non-compliance spend more time fostering proactive measures to gain a leg up on their competition. You see, when KRA officers are moving around inspecting those companies that are non-compliant, yeah, if you are non-compliant, when you hear that these officers are within your vicinity, you close down your business until they disappear. But when you are tax compliant, your operations will improve and you'll continue working smoothly. Enhance growth and tendering stroke and also merger. Growth, of course, this is expanding your business and increasing more profit. Merger is when you want to join or 2 or 3 or 2 or more companies coming together and they form a new company. That is the merger. So the process of tendering and merger cannot be completed without tax compliance certificate. It happens to be one of the certificates that are highly needed. You see, the reasons that companies merger is for synergy. Synergy is the sense that one business maybe is making a profit of 10 million. The other business is making a profit of 20 million. When they merge, they end up making a profit of maybe 50 billion or 50 million. Yeah, that means there is that synergy. There is a gain of operations, or there is a gain in profit when this business come together. Then there is operating with peace of mind. As I mentioned there, that when you are tax compliance, you can comfortably be in operation without closing down or fear of the organs that deal with the tax issues like KRA coming to your office, or of course even auditing, which may be expensive to your business. So being tax-free allows a business person to be at peace and concentrate on things that contribute to the growth of the company. Then, those are the importance of being tax compliant. Now, what are the tax structures we have in Kenya? The first is what we call pay-y or pay. Most people call it pay. Pay-y is just pay as you earn. Every time your salary is paid, your employer deducts and pays the amount deducted to KRA. Pay ensure that the yearly amounts you have to pay are collected evenly on each pay over the course of the year. And in Kenya, pay is taxed on graduated scale. There is no percentage there. Okay, there is no constant figure. The only time we apply constant figures, as you're going to look later, is on companies. So we have graduated scale for pay with a minimum of 24,000. Anyone earning below 24,000, it does not pay tax in Kenya, and must be filed before 9th of the following month. And failure to file, there is a monthly penalty of 10,000. The personal relief of the pay increased to 28,200 and or 2,400 per month as from the year 2021. There before it was less. So basically, one of the main tax structure we have is the pay or the pay-y. In this case, we are saying that your employer should remit your pay before the 9th of the following month. Failure to that will attract some penalty. Another tax structure we have is the value-added tax. It is a consumer tax charged on supply of taxable goods or services made in Kenya. A value-added tax is a consumption tax that is levied on a product repeatedly at every point of sale at which the value has been added. In other words, VAT is an indirect tax. Most of us pay VAT, but we don't feel it, or we don't even know that we are paying VAT. It's an indirect tax. And it tax on goods that are consumable. Goods that you consume each and every day. Most of them are VAT inclusive. The VAT rate can either be zero rated, and it can also be exempted. And in most cases, it is rated at 16%, except for electricity that is rated at 12%. So if goods are not zero rated, they are either 16% or 12%. Then what does this VAT mean? It means that if you produce a commodity that is consumable, maybe you have a pen, you have a book, you have a bread, you have milk, and this milk, the cost of manufacturing is 40 shillings, or the cost of buying to process is 40 shillings. Then you intend to make a profit of 10 shillings, meaning that you, as a company, to sell that product, you need to sell it at 50 shillings. But you cannot sell that at 50 shillings because you have to pay VAT. Therefore, you include VAT. Take 16% of 50. If you take 16% of 50 shillings, that gives you 8 shillings. Yeah, 8 shillings. That meaning that if you are to sell a packet of milk at 50, you now sell it at 58. The customer will buy the milk at 58, but he cannot tell that the 8 shillings on top is the VAT. That's what we talk of is an indirect tax. Withholding tax, we have withholding VAT. Withholding VAT is a tax mechanism that requires certain taxpayers designated with the VAT withholding agent to withhold 2% of the taxable value on all payments made to VAT registered suppliers or to persons who are not VAT registered but making supplies. You see, if you are doing a business and your business has sales or purchases per year of more than 5 million, you're supposed to be registered for VAT. But if KRA finds that you're making such sales and you're not registered, you will be forcibly be registered. And remember, when you are forcibly registered, you will have penalty of 100,000. So the earlier you register your business for VAT, the better. Then we have the corporate tax or corporation tax. This is the income tax levied on limited companies on their annual income. It is rated at 30% and must be filed by 6th month after the end of the company financial year. 30% is for a resident company. For a non-resident company is that 7.5. And remember, you pay 30% on the net profit. That means you must get an expert to prepare what we call profit and loss account. And an expert, it means that there are some allowances he will be able to understand. There are some taxable allowances that they may not be deducted, or may be deducted from your gross profit or even from your sales. So what we mean by that, corporation tax, when you do business as a company, 30% of your profit you pay as tax. And regardless of when you began your business, a company financial year begins from January to December. Even if you registered your company in December 1st, by the end of that month of December, you should be able to account for 30% of the profit of that month and pay as tax. The financial year does not mean that when you begin your business in November, the year ends in November the following year. No. The financial year, according to Kenya laws, it begins from January to December. So regardless of when you registered your company, you need to know that. Then that percent of your profit you remit as tax. Rental income tax. This was introduced through the Finance Act of 2015 and came into effect on 1st January 2016. It is charged at 10% on the gross rent on monthly basis. These are a form of tax that majority of people are not conversant with. I have had cases where people have found themselves in a very big problem because institution in charge of taxes, KRA, will collect your information through the water meter and the KPLC records. So you cannot lie that you constructed this building when. So immediately they find that you make, and remember for the rental income tax, if your profit or your rental income, here do not need profit, if your rental income is more than 288,000 per year to a maximum of 15 million, you're supposed to remit tax. But there's an option, if you need a graduated scale, you need to write to KRA and they'll tax you at 30% after deducting your expenses. But currently in the system, automatically 10% of your gross rental tax. If you need to know how to file the rental tax, you can watch my lesson number 2. You watch and see how to file the rental tax. Excise tax. Excise tax are taxes that are imposed on various goods and services. Various goods, services, and activities such may be imposed on the manufacturer, retailer, or consumer, depending on specific tax. And it is levied at the moment of manufacture rather than at sale. So excise tax you know, as unlike VAT, where you collect the VAT at the point of sale. Excise tax, this is tax on manufactured goods, beer, cigarettes, shoes, those goods that you manufacture. And it is imposed upon manufacturing. That means even before you think of what will be a profit and other costs, you have excise tax. And this keep on changing because government regulates this excise tax, especially on beer, so that they can collect more revenue or prohibit people from consuming certain commodities. Capital gain tax. Capital gain tax is levied on transfer of property situated in Kenya, acquired on or before January 2015. It is declared and paid by the transfer of the property. The rate of tax is 5% of the net gain. It is a final tax. The capital gain is not subjected to further taxation after the payment of 5% rate of tax. A net gain is sales proceed minus the acquisition and incidental costs. Capital gain tax is on gain arising from the sale of property, e.g. land. Now, with the capital gain tax, when you want to transfer a sale of property, you want to sell house, you want to sell land. If you bought that land at 1 million and you want to sell this land at 1,500, the profit here is 500,000 because you bought it at 1 million, you want to sell it at 1.5 million. The profit is 500,000. So you pay 5% of 500,000. That is in case you bought this land and you want to sell it. Assuming you inherited this land and you want to sell it. You inherited this land and you want to sell it at 1.5 million. In this case, you pay 5% of 1.5 million. Capital gains tax. This is tax on sale of property. And this is a must. Those who deal with business of buying and selling property, they understand it better. Good. Those are the tax structures we have. Of course, there is one which is common and I have not indicated there. That is the custom duty. Tax on imported goods. When you want to import vehicles, you pay custom duties. Yeah. So what is tax planning? Tax planning is an arrangement of financial activity in such a way that maximum tax benefits as provided in the income tax are availed of. It envisages use of certain exemption, deduction, rebates, and relief as provided in the Income Tax Act. Understanding tax timelines, penalty, and interest. Basically, in a nutshell, what we mean by tax planning is the way of preventing you to incur a tax burden. Just that. Yeah. You want to prevent a tax burden on your business or on yourself. That means you come up with a clear way of how you're going to pay your taxes in time, how you're going to pay your deductions in time, and how you're going to make use of reliefs so that you can have more income. So tax planning is a wide topic, but basically that's what we mean by tax planning. That you want to understand how can you reduce a tax burden, or how can you make use of tax for your own benefit. That is tax planning. Tax saving strategies. Then how can we have said tax planning, we can use one way of tax planning is to make use of the tax benefit so that we can have more income. So what are these strategies that you can use? Every shillings count when you are running a small business. Minimizes tax minimum or minimizing taxes may be the difference between profitable and loss making business. You see, if you are running a business which keep on having penalties, you don't meet deadlines, you don't, those kind of things, yeah? Some penalties can be so huge so that they consume the profit of your entire year. So it is good to minimize your taxes. And one way of minimizing your taxes is complying with laws, filing your tax in good time. So what are these strategies? Let's start with strategies on VAT. Added registration of VAT. Added registration of VAT obligation, especially while constructing commercial property by landlord, can extensively reduce your tax payable. Late registration of the VAT may lead to a company paying huge amount of taxes. Remember, when you register late, you may end up paying penalty. Yeah. Remember, I mentioned that if you are going to make sales and purchases that are taxable, are VAT compliant, then you need to register if those sales and purchases will go beyond 5 million. So if you are building a house that will cost you 20 million to construct that house, basically you have to go and register for VAT, because those sales and purchases that you're going to make, most of them are taxable. Yeah. Therefore, it's important to register for VAT if you are constructing your own house, or you are doing a business of construction, and the house you want to build will make you, or will purchase goods worth more than 5 million. Another way to strategize on VAT is to stay on top of adjusted gross income. Your adjusted gross income can directly impact the deductions and credit your business is eligible for. While the particulars of how to calculate this figure vary depending on specific tax laws, being aware of it is vital for tax season. Being on top on adjusted gross income, in this case, you need to have a very smart accountant who is going to understand. You see, in accounts is very complex. That's why it requires in-depth analysis, because there are things which many people don't even factor. Depreciation, depreciation, wear and tear, capital allowance. Some of these things, they can reduce your income to your advantage only if you have a smart accountant to help you to do that. Avoid penalty for the late payment. I mentioned that when you stick with deadlines, your business will grow. This may be a simple concept, but it's still a key issue and one of the most important business tax saving tips. Late payment can be avoided in a variety of ways. Getting your documentation together early in the year can prevent last-minute filing and unforeseeable expenses. Proper record keeping. Most of the people I visit to advise on tax and help in filing returns, most of them have poor record keeping. I ask them, how can you justify how you spend the 20,000 you withdraw on this date? Hey, you know that date I did this and this, but there are no documents. So proper record keeping is very vital. With documentation and good records keeping practices, you can pay your taxes accurately, on time, and save on penalty. When it comes to tax, it's more of the records than whatever you want to say. Accurate filing, accuracy when filing returns. You see, if you want to file, you want to pay 50,000, you insert 500,000. Hey, getting a refund from KRA is very, very difficult. It will take some time. So you have to be very accurate with the figures you insert in the KRA report. Basically, even in your calculations, the efficiency of your accounting software and the diligent effort put in by accounting personnel have an important role to play. Inaccuracy may lead to overtaxation. You will be having a difficult time to prove why should it be 50,000 and not 500,000 as you indicated. Bad debt expenses, bad debts which are more than 3 years old, when a company can demonstrate proof or trying to recover with no success, they can save a lot of taxes from that. You see, bad debts are expenses. And why are they declared expenses? If you borrowed 1 million from an institution, and then it happens that you are not able to pay that 1 million. After 3 years, after they have exhausted all means to recover their money, after 3 years, it's like they paid you that money. It's like they gave you a salary. So it is going to reduce their gross profit and then minimizes the tax they pay. Capital allowances. This is also something I mentioned before. This need to be very smart. This include wear and tear on machinery, software deduction, investment deduction, industrial building deduction, and commercial building deduction. And they range between 5 and 150% of the cost of assets. Taxpayers should ensure that they properly claim capital allowance where applicable to reduce their tax liability. You see, wear and tear, there are different levels. There's different classes of wear and tear. We have class 1, which is taxed at that 7.5. We have class 2 that is taxed at that percent. We have class 3 taxed as 25%. And we have class 4 that is taxed at 12.5%. And these classes have different items. Like when you have a tractor, that goes to class 1. When you have a rolly below 3 tons, that goes to class 3. When you have a pickup, go to class 3. When you have electronics, photocopying machine, computer, go to class 2. So basically at this point, and what you mean is, if you are saying that it is at 25%, if you bought your computer at 100, computer is at 30%. If you bought your computer at 100,000, after 1 year, 30% of 100,000 is 30,000. It means the value of that computer at the end of that year should be 70,000. So in your books of accounts, you will be recording that you have 70,000 and not 100,000. You will have factored wear and tear. So these accounting techniques are very vital for the survival of a business. Otherwise, you might overstate your profit or understate your profit. Now, what are the tax saving strategies on income? Income tax. Income tax, this is on the payee. How can you maximize your payee so that you earn more money? Interest expenses on loan. The interest that accumulate from a loan taken from furtherance of the business is huge. This is when it comes to tax saving strategies. Now, before we come to payee, I'm sorry for that. This one, let's consider income. You know, when we come talking about income tax, it can even be corporate tax or individual income tax. Now, for the corporate part of it, you see that the interest expenses, if you took a loan to start a business, the amount of interest you are paying for that loan reduces your gross profit. If I may ask, if you want to start a business and you have your savings of 2 million and you have a loan of 2 million, which one is more easier to operate with? Most people will say, me, I will operate with my savings. It's okay. But when you're operating your savings, remember, there is no interest that you're paying on that loan, or you are not paying interest on your savings. But this loan you acquired from a bank, maybe you took a loan of 20 million and every month you're paying 50,000. That means per year, that is 600,000. If your business made a profit of 1 million, you deduct 600,000 that you are paying on the loan. Therefore, you are going to pay tax on 400,000, the difference. That means your profit was 1 million. The interest on loan was 600,000. Then the profit then means is 400,000. It means you're going to pay 30% of 400,000. If it was not a loan, it is your own saving, and the profit is 1 million. It means you're going to pay 30% of 1 million as your tax. Therefore, it is more advisable to start a business with a loan, or to grow your business using a loan. There is what we call the cost of capital or expected return. If you took a loan of 13%, that means the cost of that loan is 13%. Your business should be able to make 13% or more. But if it is your saving, the only good thing with your saving is that no one is pushing you around to pay them. And when the business closes down, still you cannot, no one will push you to pay them. So then let's go to pay now. What are the strategies you can have to reduce the amount of pay? One is take insurance cover. This option gives you a tax relief equal to 15% of the premium you pay for your life insurance cover, up to a maximum of 5,000 monthly. It may not be much, but if you currently have a life policy, make sure you get this relief. If you have an education policy with maturity period of at least 10 years, it also qualified for relief in a similar manner. So when you have relief and you have education policy that has more than 10 years, 15% of the premiums you pay will reduce. It is called insurance relief. Will reduce your pay. Take a mortgage instead of a loan. Never go to bank to take a loan to build a house. That one is a very crazy mistake. Go and take, if you are taking a loan, a personal loan, go and take a mortgage if it is just meant for house. A mortgage is an agreement between you and the lender that gives the lender the right to take your property if you fail to repay the money you borrowed plus interest. While loan is a thing that is borrowed, especially a sum of money that is expected to be paid back with interest. Taking a mortgage instead of a loan saves on taxes. That means, I want to explain on that. What mortgage does, what mortgage does, if you're paying an interest of maybe say 20,000, and your taxable income is 400,000, you are going to take your taxable income, you less the 20,000 which you are paying as mortgage interest, meaning that your taxable income will be 380,000. It has reduced, the interest you pay on mortgage has reduced the amount of taxable income, meaning that in that tax computation, you will end up paying less. Then I mentioned about that. Let me move on. Register with the retirement benefit scheme. Pension is the top access way for many to reduce their pay tax liability. The double benefit of reducing your pay and earning interest on your contribution is very appealing. The same thing happens with the pension. When you are contributing on pension, it reduces your taxable income. If you are paying a pension of 50,000 and your taxable income is 20,000 to 200,000, that means the amount of income that will be subjected to tax will be the difference between the 200,000 and the amount of pension that you're paying, 50,000. Mean that your taxable income will be 150. So you are going to pay tax on 150,000 instead of 200,000. Get disability relief. A person of disability can register with the National Council and apply for tax exemption. Disability, anyone earning below 150,000 per month is not supposed to pay tax. Emerging issues in taxation. There is an NHIF relief for 15% of the amount contributed. introduction of VAT withholding agents, voluntary disclosure of unpaid taxes, 100% waiver on penalty. So the one that is cutting across so many people on emerging issues, it is the NHIF and the NITA, National Insurance Industrial Training of levy 50%, which will be contributed by the employer. If you are dealing with areas that are industry oriented, you are entitled to a free training paid by your employer at 50 shillings per employee. And emerging issues on ongoing tax audit, tax review, which you file in the system will be reviewed by the KRA. Additional assessment audits is being carried. And then rental and expense assessment, KRA will not access what individual have filed on the account. That means KRA will also assess what individual have filed on the account. Comparison between turnovers in income return and VAT return will be done by KRA. Advance tax. Advance tax is the amount of income tax that is paid much in advance. This tax will be subject to audit. Those with commercial vehicle, they are used to advance tax when they are taking their vehicle for inspection. That means you are paying your part of your tax in advance, but you later come and file your return and pay additional tax when you have made the profit. Import and export information on company activity will be reinvestigated. IFMIS data, KRA will be in a position to extract data from IFMIS. Rental audit based on KPLC and water meter information. So those are some of the emerging issues. Nil fillers and non-fillers across monitoring will be done by KRA. Not having payee obligation, yet having salaries as an expense is a matter that KRA will not take lightly. Yani, you don't remit payee before 9th of the following month, but in your income statement you have salaries. How is it making sense? Tax investigation on evasion, there will be a heavy investigation of people who evade tax. Basically, in a nutshell, that's what tax compliance means, and those are some of the emerging issues that we have in tax. Thanks for watching. Kindly hit down the bell, subscribe, and be alerted on the next video. Thank you.